ECB President Lagarde a few moments ago with Sarah Eisen in Washington, D.C., talking about this renewed pressure on the Fed chair. Let's talk about the market implications and this rebound that we're seeing, at least today, with Venu Krishna. He joins us here at Post 9, Barclays head of U.S. equity-linked strategies. Venu, welcome back. It's good to have you. You got thoughts on to what degree the Fed pressure is adding to negative sentiment or price action?
It certainly is, but there's so many things happening simultaneously. I think it's incremental, but the overriding concern still is the magnitude of uncertainty and the inability of investors to get some sense of when they can expect the level of uncertainty to decline. That's a question we're handling a lot, for example, and that is intimately linked to the tariff policy right now.
Right. Now, you came into this era pretty cautious, but you are now saying even areas like tech have overshot at least a typical bear market, right?
That's right. That's right. It's very interesting because the scale of de-rating we have seen in big tech especially, it's well over 25% already. That tells you that a lot of the risk on earnings and tariffs have been priced. And interestingly, if you look at big tech, especially because it's a most important component of tech, the earnings revisions are relatively modest compared to the rest of S&P, where earnings estimates are coming down faster compared to a typical year, but nowhere close to what you see in a recession. So what I would argue is that right now, for the quality of earnings you get in big tech, it's coming to levels where you have to take a look. You cannot time it perfectly, but when you start approaching 23, 22 times forward earnings for the group as general, I think it's worth looking at.
That said, speaking of timing, I mean, none of them reported earnings yet. We've got a little bit. Tesla will get after the bell tonight in terms of at least considering it big tech. I mean, do you have any expectations when it comes to earnings season overall, particularly for this group? Yeah,
so we don't include Tesla in our big tech, just to be clear. But for the rest of them, the consensus numbers are closer to 16%. So at the beginning of the year, we were expecting it to be 21%, so which is still a lot less than the scale at which they've been beating their numbers for the last 6 to 8 quarters. So I would suggest that even if you get 16%, I think that's very healthy compared to the rest of the market. So remember, when we cut our earnings number for S&P about a week before Liberation Day, we took down our growth estimate from around 12.5% to 6%. But our downside case of a bear market, which increasingly is seeing a higher probability than even just 3 weeks ago, we have earnings going down 2.5%. I think if you look at the real impact of tariffs and the second-order impact on growth and inflation, that number can even go down to about 4.5%, 5%. So you were talking about 20 percentage point swings in what can happen. So in that context, when you look at this group, where the numbers have not moved a lot, for the rest of S&P, like I said, numbers have come down faster than what you would see in a typical year, but nowhere like what you would see in a recession.
Are there then lingering or second-order liabilities from, I don't know, advertising or, consumer that might affect names like Meta or Amazon at least?
I wouldn't go into single names, but I would certainly say, just remind you that the two central pillars of U.S. economic strength over the last 2 or 3 years have been, one, the consumer, and second, tech. And both on the margin have weakened at this point in time, right? And the consumer is the most critical element to the U.S. story, right? We are such a consumption-driven economy. If you see, for example, hypothetically, a 2% increase in savings rate, which has been very, very low right now compared to pre-COVID periods, and you see, let's say, a 2% cutback in consumption, that can have a massive impact, including on advertising revenue eventually, which will affect tech as well.
Right.